morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Stock rally spreads from US to Asia after the Trump administration delayed the implementation of recently announced tariffs on China. Oil surged and gold fell. Retail inflation back home fell for the first time in 6 months to 3.15% in July as demand moderates further. Food inflation softened while there was deflation in fuel and light prices. NBFCs looking to sell pooled assets to public sector banks will have to report positive asset liability management within 3 months of selling such an asset. Pakistan calls on the United Nations Security Council to convene an urgent meeting on India's decision to revoke autonomy for Jammu and Kashmir. Alleges there is clear and present danger that India will provoke a conflict with Pakistan to divert attention. And lots of rumors surrounding the next 2 days as well. So just please be very careful about listening into the rumors and, of course, just being careful in general. However, the markets are not careful. They are happy because of the delay in implementation of tariffs. Now, the US has granted the grace period on tariffs on a wide range of Chinese goods for the Christmas season. Now, as a result of that, the US markets went up. Post that announcement, the US markets went up and then stayed up for the better part of the trading day. So 1.5% higher for the S&P and the Dow, the Nasdaq up about 2%. But essentially, if the intraday would have shown, as you can see, the sharp surge up post the announcement and then inching up. So good day for the US markets. It's percolating down to the Asian screen as well, with Nikkei up about 0.7%, Shanghai about 1%. I would reckon that this is not a long-term solution and therefore not a long-term benefit, but we take it for a day if it comes, looking at the carnage that we've had in world markets and India in particular. So therefore it's not a bad Asian screen, and it's looking okay for the SGX Nifty as well after the slam dunk yesterday. Likely to start off marginally positively, but keep in mind, yesterday too we started off well courtesy Reliance and then gave way. Let's wait and watch what happens in the trading session today. That's the key thing. I mean, we've retraced from about the 200-day moving average levels for the Nifty, despite Reliance doing well. So we're finding resistance out there at the 200-day moving average, and Reliance is finding resistance at 1300 too. So if the support from Reliance doesn't stay today, which it may not, then let's see what happens to the Nifty, because while Reliance did well, all FI-owned stocks came off quite strongly. So the sell number in the cash market, FI's sell number in the cash market was only 600 crores. But FI-owned stocks, HDFC Bank, Bajaj Finance, a clutch of other consumption names, all of them came off quite strongly. So you've got to ask yourself whether there are future positions being built out there as well. And we'll talk about that. So, and you know, I mean, as I said, the global rally may help the day's trade, but I think the larger overhang on the Indian markets because of the economy, the floods, etc., and the yuan devaluation, all of them do stay. So difficult to see how much will we rally on the base of this one decision that has been taken. But we'll get there. Maybe talk about flows in a bit with Cameron Brandt as well and get some clear perspective too. However, all of that is for the medium term, for the short term, for the here and now, for today. What matters? What are specific stocks likely to do? Firstly, the results that are going to come out today on the Nifty as we approach the end of the earnings season. Hardly anything left, but Grasim is one name that will come out with the results. With Vodafone Idea plummeting the way it is, the stock is plummeting, but let's see if the results turn out any better. In other key results, Jindal Steel and Power would be important, as would be HEG after the kind of numbers that Graphite came out with and the reaction that we saw on both yesterday. Let's see what HEG does. That aside, CESC, very important number. In the process, the gas and Edelweiss Financial Services, they have the press meet today to talk about some business issues as well. So, or reorganization or something like that. So very important to monitor Edelweiss in the session today. However, in terms of stocks that you should monitor on open, there are 4 or 5 names which I think are really, really important. Firstly, Coal India. The results were above estimates. The higher FSA realizations and stable employee costs drove the profits higher for Coal India. The FSA realizations were higher due to higher contracts essentially from non-regulated players, which may not necessarily last in the quarters ahead. But for now, I think the street will take the numbers as they come or as they have come. Maybe the stock could react positively today. United Breweries could probably react negatively today. The results were below expectations and gross margins were weaker. You would at times understand if EBITDA margins are weaker, but gross margins were weaker which wasn't the best, and the slower growth in the mild beer segment did impact the top line. You've got to ask Shekhar Ramamurthy if these is structural or cyclical or one-off in nature, but this is an important one for United Breweries. The volume growth was a 5% number versus estimates of 6%. Now, we've seen the FMCG players do well when volume growth has beaten estimates. In this case, the slower volume growth might just come back and bite United Breweries bad. Let's wait and watch what happens to that stock today. Dr. Reddy's will surely react. They've received a CRL from the US FDA for the NDA filing, which means the potential delay is possible in that. Let's wait and watch what happens to this stock. In all probability, should react negatively. We'll talk about Dr. Reddy's a bit later on in the show with great focus. But this stock should react negatively today, as would probably Sun Pharma. By the way, the commentary wasn't the best. Watch out for HDFC Life Insurance. Standard Life is seeking about $350 million from the sale of shares. This offering is at about 477 to 493. So likely that the stock may start off lower in the session today. And lastly, Bloomberg News has reported the Future Retail. In the case of Future Retail, Amazon.com is in late-stage talks to acquire as much as 10% in the company. Let's wait and watch what happens to this stock in the session today. However, in the big conversation that we are wanting to bring to you today, in a de-escalation of the trade tensions with China, the Trump administration has delayed the newly announced tariffs on some Chinese products. The 10% tariffs will be imposed on a variety of consumer products, including smartphones, laptops, children's toys, only in December. This has halted a slide in global equities, but likely that this might be viewed as just a temporary relief. Are experts thinking of it that way, or will the money start flowing back into equities? And also, is the sell-off in China just an outcome of global tensions, or are domestic factors to blame as well? What will happen to flows in the event or in the view of what China is doing with regards to the yuan midpoint setting? Let's put all of those questions to Cameron Brandt. He's Director of Research at EPFR, Informa Financial Intelligence, joins us right now on the show. Cameron, thanks so much for joining us this morning on Bloomberg Quint. What do you think of what's happening to flows on the emerging market pack? Because the last few days, if India is an example, there are stark outflows that we're seeing from India and likely from a clutch of other markets as well. What's happening here?
I think that it isn't just India, it's emerging markets as a whole. And I think the main culprit is the unresolved trade tensions. The U.S. and China are obviously dominating the headlines, especially in an emerging markets context. But it's a virus that is spreading rapidly. China and Korea are currently embroiled in a local version. The news we've been getting from the German economy has highlighted the fact that it's rapidly becoming a global phenomenon. And though, the emerging markets universe is no longer purely a trade to developed markets play, it's still very significant, and investors tend to use that as sort of a key filter when deciding whether to go in and out of the asset class.
What's your sense, though? Do you think this phenomenon continues? Because while there are some reconciliatory, or not reconciliatory, but temporary grace tones coming in from the U.S. overnight, it's probably only a one-off move. The larger pain points still remain. Do you think this risk off would continue?
And I agree with you that I think this is only a temporary reprieve. We're moving deeper into the election cycle leading up to the 2020 presidential and legislative elections here. And the Trump's tough stance on trade, while the direct impacts, ironically, are quite painful for many of his support groups, are still broadly popular. I don't see him backing down. And I think China has decided that it might be in their best interest to just wait it out and see if, there is a change of government 18 months hence. So my sense is no, having let this particular genie out of the bottle, it's going to be very hard to get it back. the process of erecting trade barriers gives the politicians a lot of favors to hand out. And once the barriers go up, there's usually a domestic lobby that wants to try and keep them in place. So no, I don't see this settling down anytime soon. And I think partly because there was so much optimism earlier in the year that this would sort of slowly work its way to a conclusion by the second quarter. The pendulum has now sort of swung in the other direction, and the general sentiment is really pretty pessimistic about any resolution, certainly this year.
Have the outflows accelerated in any meaningful way post the yuan sliding sub 7 and the midpoint yuan being fixed sub 7 as well?
Yes, they have. They basically have jumped from an average of somewhere around 700 million a week. They were up over 5 billion last week. This is for emerging markets equity funds. And it's looking to me like it'll be another 4+ billion going out of them this week. So yes, we've seen a pretty dramatic and immediate impact once the potential for a currency angle surfaced.
You reckon that will continue, Cameron? Because it's like a line crossed in the sand. I doubt that China, I may well get proven wrong, but after having taken 4 or 5 steps and 4 or 5 fixing of the yuan midpoint sub 7, it's difficult to get back below that or above that. Do you think the outflows would continue?
I do think that it's going to be a tough environment for emerging markets equity funds for a while. All the attention at the moment is on, trade. But I think we're going to have more dispiriting news out of Europe through sort of the remainder of the year. Europe is sort of heading into a perfect storm, I think, early in the fourth quarter. It looks like Italy is going to force elections. The chances of a hard Brexit for the UK have increased dramatically. The negative interest rates are going to put much more pressure on the still kind of unreformed, unrestored banking sector. So. No, I think there's going to be other pain points that make people more risk averse, and I think there's going to be I can see some things happening in the emerging markets universe that are quite outside the trade. That's also going to keep people on edge. Argentina has been much in the news recently, and I think if the Kirchner ticket wins as it now looks, that's going to remind people of the risks. Optimism about reform in South Africa is running into the hard reality of just how much damage was done. So no, I see plenty of catalysts for further volatility through the remainder of the year.
The only counter, at least from an emerging market perspective, is what's happening to rates, right? Morgan Stanley yesterday put out a note that they expect the Fed fund rates to go back to 0. Yields have anyways been falling, save for that flash uptick yesterday. In such a scenario, do you think the outflows would be a bit more contained than what they would have been if the Fed would have been on a rate hike spree?
That is a good question. I think if the Fed quickly takes the rates back to 0, the broad assumption is going to be that things are much worse than anyone expected. I do not think that will be good for equity flows in any sense. Obviously, the markets would not greet another U.S. rate hike warmly. But honestly, the fundamentals here still don't really support any aggressive easing. Inflation seems to be picking up. The job market is about as tight as it can get. Corporate profits are still at a very high level historically. So, my personal hope is that the Fed eases very cautiously. Partly, at some point the cycle will roll over, and it will be useful to have some fat to cut in order to respond, and partly because I think there is a danger of sort of creating some really sort of longer term problems if credit is too cheap with the economy in the relatively robust state that it is in now.
Cameron, I was actually more asking this from a perspective of how would the flows into EMs be, because relatively the growth might be better, and in the case of the falling rates, maybe money might want to go to places of growth as well after parking themselves in places of safe haven. But let me turn the focus on India. Now, India has not done itself enough favors with the tax changes that have come about in the budget. AIFs presumably have gotten impacted because of the surcharge, etc., etc. How have you looked at the flows out of India? Because the month gone by, which was the July month, was a really bad month in terms of outflows from an Indian perspective.
Yes, it was. And, you've outlined some of sort of the immediate factors that have sort of put investors on edge. There was some trouble in some of the I'm trying to remember what you call them, but there was sort of some fixed income investment vehicles that had a bumpy ride. There's a certain amount of monsoon watching that always goes on at this time of year. But longer term, India continues to check a number of the boxes that are likely to, at least on relative terms, keep the money going. It has a reform story, though, of course, you can debate quite how much of a gap there is between the rhetoric and the reality. It remains a defensive trade play in that you are still, as a country, less exposed to international trade than many of your peers in emerging Asia. Weaker oil prices are generally a positive for the Indian story. So my sense is that, certainly through the remainder of the year and into next year, I'm not going to forecast any huge positive flows into India, indeed really any emerging market, but I think India will relatively do better than most of its peers, and that sort of relative outperformance on the flows front will be greater the tougher things get.
Yeah, but what's the nature of the money that's moved out, Cameron? Is it possible to decipher that? Is it passive money? Is it active money from AIFs or otherwise who've seen these tax changes and thought, let's just take a bit of a risk off? And any sense thereof?
Actually, it's been a combination of both. It really hasn't been one or the other, which is a bit different. One thing we have seen this year, and I think it's sort of, certainly I think another faintly worrying signal is that certainly from 2013 on, when we had big outflows, it tended to be sort of the active side of the fund universe that was leading the charge. But this year, we've seen more ETF outflows than we have in a while. So it's been more of a 1-2 active-passive punch this year.
Okay, so maybe both categories. Final question, Cameron. How have you looked at flows into commodities? Gold arguably would have seen a lot of flows. How do you decide? What's your verdict there? And what about the other commodities? Because I think base metals have been hit high. I reckon that money would have moved out considerably. How do you see that part of the picture shaping up?
Well, you're certainly right that there's been a marked jump in flows into funds dedicated to gold and precious metals. There was also a reasonable amount of money certainly the last couple of weeks that has sort of gone into hard commodities funds that aren't necessarily precious metals. So I do think that with the return of broad financial repression and the sense that currencies and actively weakening them may be coming into play, any kind of tangible asset is going to come back into favor. And we've certainly seen a bit of that in the commodity sector fund flows recently.
Okay, Cameron, thanks so much for staying up for us and for speaking to us at Bloomberg Quint today. Appreciate your time.
You're welcome.
That's the view from the Director Research of EPFR on flows and how they have done. Well, we slip into a break, but lots more lined up on Indian Open. We speak with Mihir Vora of Max Life Insurance about how to deal with the volatility in the Indian markets, discuss the consumption slowdown in India with Vinita Bali, former Managing Director at Britannia Industries, and the June quarter earnings with Amit Kalyani of Bharat Forge and VP Nandakumar of Manappuram Finance. But after this break, a full tilt towards the day's trade.